When you first get started learning about the stock market, you'll probably get a lot of advice about whether you should be picking individual stocks or something like ETFs and index funds. Now, a lot of advice is going to point you towards the ETFs and index funds, but in this video, I want to share why I think the best place to begin is actually with individual stocks. So let's get into this. As is true with most things in the world in general and with stock markets in particular, any advice you're going to receive from anybody is not really a one-size-fits-all type of thing. But if I was to summarize in one word why I suggest individual stocks over ETFs or index funds at the beginning, it is learning. When you're first getting into the stock market, you could, if you want a totally hands-off approach, just choose a reliable ETF that essentially just follows the growth of the market in general, or the S&P 500 in general. If you want a completely hands-off, you don't care about learning type of approach, you just want to put your money somewhere and not think about it, maybe this is an okay way to go. With some caveats, not completely. I mean, you want to pay attention to where your money is in general, no matter where it is, not just completely forget about it. But I think that when you're first starting into the stock market, and this is my personal experience, I had first started off by spreading my money into ETFs and used some to learn about some stocks. Now, the problem was I'm not super rich. So when I was putting about half of the money I had in my brokerage account into these ETF funds, and then I was putting another half into individual stocks, it just gave me a less room to maneuver and kind of try to learn the market. And this is the main point that I'm expressing here, that when you're first learning the stock market, it's less important that you're making that 1 or 2% gain. Or what's more important at the beginning is that you're learning how the system works, how the stock market in general works. What are the things that cause and influence positive growth, and what are the things that influence losses in the stock market? Because it's not always so direct. There's a lot of psychology involved with why prices go up and down. There's a lot of kind of broader things happening in the world that affects things. Geopolitics, tweets that go out from prominent people affect things. There's a lot of things that affect the stock market. And until you have a better grasp on that and on how to understand what is a good company, what is an undervalued company in the stock market, what is a risky opportunity and what is a less risky opportunity, what is something that has high upside and what is something that's safe but has low upside. Once you have a better understanding of this, then it will make it easier for you to make choices. This isn't to say this is always going to end up leading into you making more money at the beginning. In fact, it could very likely do the exact opposite. An ETF is often, depending on the ETF, there's certainly a lot of different ETFs, but generally, if you just get something like the VOO or one of the other ones that just kind of follows the S&P 500, you kind of know what to expect. If the market in general goes up 10%, your stocks are going to go up 10%. I think it averages out year by year. If you just invest in the S&P 500, you're gaining 8%, 10% a year, which is great. I mean, it's going to have some ups and downs. And if you have short-term volatility where you're going to be in a big hurt situation, if you lose a lot of money in the short term, then you want to be careful about the stock market in general. But if you have a little bit of a longer-term outlook and you're putting money in the stock market for the longer term, there's going to be ups, there's going to be downs. And an ETF will just kind of follow those ups and downs. And historically, those tend to go up over time. Historically, you never know what's going to happen in the future, but historical perspective is very important for the stock market and not getting kind of overly caught up in the moment. And as crazy as things can be at times in politics or in partisan politics of the US, as crazy as things get, you have to always keep things in kind of that historical perspective. It's not always as doom and gloom or as sunshine and rainbows as we tend to think it is. So if you have that historical perspective, it helps you psychologically to not get kind of caught up in hypes. But at the same time, that ETF doesn't give you as much opportunity to learn. You're going to see that go up and you're going to see that go down, but you're not necessarily going to know why. Within that ETF or that index fund, there might be certain businesses that are excelling and doing extremely well, and others that are losing money, and then they're just averaging out to something close to the midpoint of the S&P 500, which isn't a bad thing. If you don't care about learning and you don't care about thinking about your money, that's probably fine. But if you really are trying to understand how this works, if you pick individual stocks and you watch them closely, don't change them all the time. Don't be constantly every couple of hours buying and selling. There is an approach of day trading that people will have, but that's a different game. If you're looking to just understand the stock market, buy smart choices that are going to go up in value over time. In order to understand the market, you have to understand what makes a good business. So if you are identifying individual stocks, you're analyzing those individual stocks, you're seeing what are their business practices, what are their profits quarter by quarter, what is the market sentiment around them, how psychologically are people thinking about this particular business, what are the reasons that it's gone up or it's gone down in value to this point, what are the things on the horizon that seem like they could gravitate towards causing this to go up or to go down into the future. Understand understanding all of these different things and understanding what some of the numbers mean when you look at things like a PE ratio, even what the limitations of some of the numbers are as well. But once you have a better read of these sorts of things, then it's much easier to start to make choices that reflect that learning, and then you can start to succeed more over time. Now, a lot of people don't succeed as much as an ETF would succeed, but I think a lot of that is because they're not learning as they go, and I think this is really key to the process. As you're making choices, as you're seeing things, as you're having experiences, you're able to make adjustments. Even if you wanted to start off in the stock market with a very small amount of money, just to understand how it works, this is a good approach. Now, there's one big caveat I have to put here, and that's you have to be aware of your own risk tolerance. If you're starting off and you don't know much about the market and you're choosing individual stocks, there's a good chance you're going to lose money. There's a good chance the assumptions that you make about certain things are not correct. You don't have enough experience in the market yet to kind of understand how it works. So maybe you're relying a little bit more on either intuition or on a couple of YouTubers or on AI analysts or whatever it might be. But until you have a personal inside yourself understanding, then any choice that you make is going to have inherent risk for sure. So I would suggest, if you don't have a lot of risk tolerance, you could get some ETFs, that's fine, but still leave yourself some amount that you can kind of learn with. If your risk tolerance is low, then maybe that amount is smaller. But and maybe it's even like fractional shares or something instead of buying full shares, just so you can start to understand the dynamics. You can make a couple bucks here, lose a couple bucks there, just begin to understand a little bit more how it works. I wish I had been taught in high school. I never had any kind of class around this. And even when I was in college and took an economics class, I still didn't get any background information around personal finance or around how the stock market works. So if you don't have that background, you got to create a space for yourself to learn. So if your risk tolerance is low, put some money in an ETF that's a little bit more standard, but then keep yourself a block of money that you can just kind of play around with and try to figure out how the system works. When you're doing this, I would suggest starting relatively small and really making choices with deep research with each choice. Even if you're only going to be putting $10 into this thing, research it. Understand, where are you putting this $10? What is that business? What is their forecast? What are analysts saying? What are YouTubers saying? What is AI saying? Don't take any of those as gospel, for sure. There's a lot of good advice that could be found out there, but it's just something to start your own exploration and to start your own searching. You have to understand yourself. Put a little bit of money, even if you put $10 into this one stock, understand it. Understand where their valuation is at. Understand where you think this is going to be going. If you see movement up and down, research why. What caused that to go down? What caused that to go up? Watch it. Capture that learning. Keep it for yourself. Write it down if you need to, but be very systematic about really learning things and understanding things in a broader way. And then you'll be able to make better choices later and maybe gradually start to increase the amount that you've put in. So don't go in all gung-ho, throwing all your money into this new hype stock, this new meme stock or whatever, but make wise decisions. There's different ways to play this game. I say it's a game. This is not a game. This is a lot of money that you're putting in. If you want to chase the meme stock, you have a chance to make $1 million overnight, but you also have a chance to lose everything that you've put in there. And I'm not going to risk my life savings on a lottery ticket. Maybe there's a certain percentage of the money you put in there that you do want to play the penny stock game, but you got to find those. Even if you do that, you got to find those businesses that aren't just hyped, but that actually have some structure, some foundation that you can build from, and that the stock can build from, that the company can build from. And it's not just based on what people are talking about or based on what the chart currently looks like. This is another thing I notice a lot of YouTubers will really analyze the chart, but not the business underneath the chart. And the chart tells you something, but it's just part of the story. You have to understand the business as well. If you don't understand that, the chart can go any which way. If the business foundation, if the fundamentals of the business are not strong, then where the chart is currently doesn't really matter because the business itself is not strong. So you have to understand that. You have to understand the business, and picking individual stocks will help with that. Now, as I say this, one important caveat to keep in mind is that even as you're picking individual stocks, don't get stuck in one sector. This is also a risk that I think, like if you are interested in technology, for example, and you've seen a lot of hype in technology, it may lead you to just wanting to buy technology stocks. And historically, those can be some of the best ones, but those can also be some of the most volatile ones. So even if you're picking individual stocks, it's really useful to try to learn about a variety of different sectors. Look into the energy sector, look into the real estate sector, look into the healthcare sector, look into all these different sectors. Try to understand the realities of those sectors. What are the businesses that make the most in there? What are the businesses that influence the market more than any others? What are some of the partnerships that exist nowadays with the US government investing in companies? How is the US government investing in companies? Don't let the hype of that cause you to make a choice, but become aware of that. Understand the relationships between companies, and then understand the variety of sectors. If you become more comfortable in a variety of sectors, then it's also easier to pick and choose stocks and diversify them in a way that makes you safe, that you can still have potential for a lot of growth. But if the tech stocks come down really low, but you're really well covered in like infrastructure and energy and real estate or whatever in those areas as well, then it mitigates the risk from your high growth tech stocks that you might have as well. This is something that I've had to learn a little bit the hard way, not super the hard way, because I am taking this like slowly as I personally am also learning as I go. I think for a while I was too focused on some of the high growth tech stocks because they're the exciting ones, they're the fun ones, they're the ones that are leading us into the future in some very fascinating ways. And they're in the media a lot, and we're very aware of them. My son likes technology. I can have chats with him about different things and different reasons I'm buying tech stocks and stuff. It's just a fun thing. But I've seen days where those stocks, a bunch of those kind of stocks, all go down at the same time, whereas my other stocks that are a little bit more boring sometimes did much better for periods of time. You know, my Nike stock did quite well, my Costco stock did quite well, whereas, you know, my Navitas stock or my Applied Digital stock went down significantly over a couple of days. It's nice to have that balance. I think that Navitas or that Applied Digital has a lot of potential for the future, but it's not built on a super strong foundation. It's built on a foundation of possibility, strong possibility. So I'm willing to put a certain amount of money into those strong possibilities, but I have to be aware of all the sectors so that I'm not putting myself at too much risk. I don't have the freedom to do that because I'm not rich. You know, sometimes a lot of these YouTubers they have a little bit higher risk tolerance than me. They can put a lot more money into something that's a possibility with a really high upside, because if it doesn't work out, it's okay. They've got a lot of other streams that are making it work out, and it'll be okay for them. I can't necessarily do that. I don't have as much risk tolerance. I've lived my career as an educator and working in the nonprofit sector. You know, my wife and I were very, very low income earners. So we have to be very careful with what we do with our money. So we can't be super risky. I do want, and I see internally sometimes, I'm like, oh, that one, that has the potential. That's gonna be the big one right there. That's gonna help us, get a better car or whatever it might be. Because, really, I'm driving around a 1996 Ford Ranger, which I love. It's great. It's so old and it's doing great. But I notice myself at times like an urge to go towards some of those high potential, high upside, risky stocks, just because I'm like, oh, let's make this big money right now. Let's make this big money right now. But you got to be careful. If you see yourself approaching it that kind of mindset, step back a bit and be like, okay, I recognize this is risky. How much do I want to put in? How much can I put into this? And I'm willing to risk. If I lost this all, or if this stock went down to almost nothing, this business was not able to become successful, was not able to become profitable, and it went down to nearly nothing, would I be okay? Or would this be really, really hurting me? If I don't step back and ask myself that question honestly, then I'm really playing a game of lottery in here. I have to be able to ask myself that question as I make decisions. And this is one thing that I think is very important for us lower income earners to understand. A lot of people who are in the stock market more, and that are the voices that you're hearing on MSNBC or on YouTube, they're wealthier. Hundreds of thousands or a significant amount of money to put into this. The one thing that's very clear in the stock market is if you have a lot of money, it's easy to make a lot of money. If you don't have a lot of money, it's hard to make money. The rich get richer, the poor have difficulty keeping up. It's just the way that the system works as it's currently set up. And a lot of the YouTubers that I watch, that I enjoy, that I learn a lot from, they're also quite wealthy. So they're making choices and doing things with a certain amount of risk tolerance that I personally don't have. So you have to be aware of your own risk tolerance and make decisions and learning decisions, but be aware of the psychological mindset that you have as you're approaching each of these decisions, and make sure that you're really researching deeply. Anyway, there's a lot of things in this video. Kind of went a little bit more warbly around than I was expecting it to be when I was first kind of outlining what I wanted to talk about in this video. But I think this was all useful stuff. If you enjoyed this, please do hit the like and subscribe button. I'm brand new. This channel has just begun, and I'm hoping to get at least a beginning beginning of some subscriber base here. So please do hit the like and subscribe and comment below and share your thoughts about all of this. And I look forward to seeing you in the next video. Peace.